breaking news seconds away from the release of the latest Beige Book. The report, put out 8 times each year, gathers information from regional bank and branch directors. It is one of the best barometers of the health of our economy here in the U.S. Well, here it is. We are getting those headlines now. The Federal Reserve saying manufacturing expanded while economic recovery slowed in some areas. Bloomberg's economics editor, McKee, is here with me to page through today's Beige Book. So we are also joined by one of Bloomberg's best, David Resler. David is managing director and chief economist at Nomura Securities. What did you see?
What I saw is the opening sentence said that economic activity continued to increase. Now, I thought that the stress might be more on how much things had weakened. Now, you have to go through the details that Mike cited to find some of that evidence of weakness. But on balance, one of the sectors that they talked about where I was a little surprised at the tone was in retail. Retail sales have been pretty disappointing of late, and yet this report cited half the districts had increases, half had declines, and 2 were flat. So it's essentially a balanced report. And to me, balance is the relevant word. In recent months, we've seen discouraging economic data, leading some people to fear a double dip in the economy. Nothing in here suggests that we're in any sort of deterioration of that sort. We're seeing persistent weakness where we've seen it in commercial real estate, weakness where we expected to see some of it in residential real estate after the expiration of the home buyers tax credits, and retailing holding up while manufacturing has slowed. And I think that for those people who thought that manufacturing was going to be simply a straight line up, they might be disappointed, but the reality is that isn't how business cycles evolve.
So what do you think it is that's encouraging Ben Bernanke to tell Congress last week that he sees the economic outlook as unusually uncertain?
Well, it is unusually uncertain. And if we go back to the minutes of the June FOMC meeting, the participants at that meeting cited sources of uncertainty as twofold. One is re-regulation of the financial services and structural reform of the healthcare industry as a source of domestic uncertainty, and the uncertainty overseas in Europe from the contagion of the Greek crisis. Now, it looks like the latter of those has been contained. We're going to be living, though, in an environment of uncertainty on 2 key domestic industries for a good while. And unfortunately, both those industries are critical to the overall economy. Every company has to be concerned about healthcare costs, and every company is concerned about credit conditions.
I want to pick up on real estate, your comments, both of you, on real estate, both residential and commercial real estate remaining weak here. There's been a lot of talk about the outlook for prices, and deflation has been coming into a lot of discussion. Where do you think we're headed as far as that? Is deflation a threat?
We don't think that we're going to go into outright deflation, but we think we're in a period of very low inflation. We think we're going to hit record lows on year-over-year core CPI, for instance, later this year. The record, I think, is 0.7% year-over-year. I think we'll break below that for a month or two.
The only question is whether we have any kind of shock that pushes the economy down below the 0 level on inflation. We have had some good news lately, especially for the core, in that apartment rents are rising, and that's about 40% of the core. So that may push things up a little bit going in future months. But as David said, we're going to have a long period of low inflation.
You guys are unbelievable with the statistics. It's really impressive. Is there a disconnect between the spending? We saw this with the exception of the Gulf Coast reporting that BP implication, but spending is okay. Tourism, though, had an uptick, right? Yet consumer confidence is depressed. Is that a disconnect going on there? I mean, how do you make sense of this, and how much spending will support this struggling economy?
Well, there's one element of consistency between the Beige Book and recent consumer surveys. Recent consumer surveys have shown disappointment to us in terms of planned purchases of big-ticket items, and we're seeing confirmation in this report. While retail overall was doing okay, it was largely focused on necessities and consumer non-durables, whereas durable goods consumption, demand for that has been weak, especially in the cars front. And there was an area where I was a little disappointed. We haven't seen the July car sales numbers, but this suggests that we're not going to see much of a bounce from the relatively low June numbers.
Big question, of course, is and the big number before the Fed meets is what happens with jobs. How soon does the uncertainty lift enough for companies to start hiring? We see in this report that we're still seeing a lot of temporary workers get picked up, but not real strength in people adding to their payrolls.
Well, this gets back to the uncertainty question. Why are companies hiring temporary workers instead of putting people on permanently? I think the answer is uncertainty. Uncertainty about what? The economic outlook, and uncertainty about the long-run cost to them of retaining permanent workers when they don't know what their health care program they're going to be able to offer is going to be.
And banking conditions, we learned today, not improving. This has been another ongoing story, this especially directed to small business. Washington seems to be all over it. Banking and business, small business, regional, state governments really having a hard time here, and this is going to continue to be a drag, correct?
Exactly, but also what I noted in there as well is weakness on the demand side. I mean, people aren't clamoring to borrow money either, and I think that's an ongoing problem. Now, it's interesting, in last week's testimony before Congress, in the document, in the testimony report itself, at the appendix of that testimony was a 20-page report on small business and small bank loan activity and credit conditions. And there seemed to me to be a strong hint that the Fed is concerned. And in fact, in the testimony, Bernanke talks specifically about actions they're taking to make sure that banks aren't overly restrictive on lending.
We're out of time. What a bummer. It's a pleasure. Really, really great to have you on set today. David Resler and my colleague Michael McKee. Gentlemen, thank you once again.